Thanks everybody for joining us here for our inaugural Gundlach Unlocked webcast. I always talk about the Fed follows the two-year Treasury yield. And I've used to get pushback on this. I'm getting less these days than I did a few years back. But you can see on this chart, the gray line or the tan line is the Fed funds rate, and the blue line is the two-year Treasury yield, and this goes back 22 years. And it's pretty obvious that back in 2004, the blue line started to go up before the Fed line. And then in 2027, the blue line started falling before the Fed cut rates. And then finally, before the Fed started raising rates in 2016 or so, we see that the blue line started rising and so forth. And in most recent time period, we see that the Fed was pretty far behind the two-year. If you look down at the bottom panel, the shaded areas, the red shaded areas is when the two-year Treasury is below the Fed funds rate. You can see just how very far below the Fed funds rate the two-year was when the Fed finally started cutting rates in September of 2024. So this is just that proof statement that the Fed follows the two-year Treasury, and you could actually take this back to the 80s, and it would show the same sort of a pattern. So we see the two-year Treasury rate has come down a fair amount since the Fed started cutting rates. Here's the 30-year Treasury yield, though, and we've got drawn on these what were kind of channels that kind of defined and contained the secular decline in interest rates from 1990, starting on this chart, all the way into 2020. And you'll notice that there's no rally in the 30-year Treasury. As we've seen the two-year Treasury fall in anticipation of the Fed cutting rates, the 30-year Treasury yield has barely rallied at all. It's really only about 30 basis points below its all-time high. And so the drawdown on the 30-year Treasury bond is still almost 50% from where it was in price back in 2020. So we continue to not recommend the 30-year Treasury bond as an overweight, even though, as you can see on this chart, that it's stopped rising really for the past year or so. Here's an interesting chart on inflation. This is the CPI core blue line. And we have this dotted line, which would represent the Fed's stated target of a 2% CPI, or they use PCE, but it's about the same as the core CPI. And you'll notice that for years, from 2005 until 2020, the CPI was trending with very little variation right on that 2% trend line as a base case. And ever since then, we've had a totally different trajectory on the core CPI. What we did on the bottom is just a simple calculation. What would it take to get the CPI to be at 2% for the next, get to 2% over the next 5 years? You'd have to have a CPI of 0 for the full 5 years to get back to that 2% trend line. That seems really unlikely. And then to do it over 10 years, you would need a 1% CPI for 10 years. For 15 years, you would need a 1.3. And all about to 25 years, to get to 2%, you would need a 1.6 inflation rate for the next 25 years to get back to the two-year inflation target trend line. So we're still quite a ways away from there. So as I stated after the last Fed meeting, I don't think we're going to get another rate cut from Jay Powell, and that seems almost assuredly true at this point with all the volatility that's going on in the commodity complex, most notably, of course, the energy complex, which has had a $40 swing in the last 24 or 36 hours. It went all the way up to 118 on West Texas Intermediate and then fell back down to about 80 or so. And now we get news that Iran is starting to lay mines in the Strait of Hormuz. And so oil has kind of rebounded partially back to about $85 or $86 for West Texas, but there's a lot of volatility there. Here's what the Fed looks at, the PCE. The blue line is what their favored measure is. That's the core PCE. And we can say that it's not trending lower anymore. In fact, it hasn't really been trending lower since really 2 years ago, back in the first quarter of 2024. So we believe that with this oil spike that we should probably be adding something like 0.4 to the inflation numbers versus where we were on oil at about $60 a barrel, maybe even 0.6. So we could easily see the inflation numbers go into the mid threes in the several months or quarters ahead, certainly by year end. So this is something to keep an eye on. Clearly, we do not any longer have a headline PCE that's trending lower. In fact, that tannish line and the bluish line, but certainly the tannish line, are kind of powerfully moving higher. Here's the gold spot price, which has been absolutely insanely positive ever since it broke out above 2,000. We see that it went all the way up to over $5,000 an ounce, and now it's consolidating again. It feels almost like it did back when it was hovering at about 3,200 or so last year. And I pointed out at the time that in spite of the fact that we've had this massive move, we only go sideways. We never seem to have a true correction in the gold price. If we think about how long that consolidation period was from 2010 until about 2020, 2021, one can expect that the gold price should probably go higher. So I think investors should own gold. I think investors should be in commodities for about 50 commodities slash real assets for something like 15% of their money. And I would have 10% of that in gold of the 15%, and the other 5% in a commodity basket like the Bloomberg Commodity Index. That has a little bit of gold in it, and gold is certainly helping propel the price higher of the commodity index. But I really think that gold is the number one commodity that I want to own. I believe deeply that central banks will continue to diversify out of dollars, keeping the dollar weaker on balance, and also be buying gold, and the gold price will be well supported. Speaking of gold, here's a chart that goes back to 2020, 2021, and we have Bitcoin. The scales are different, but you can see how they line up in terms of their directional movement. The blue line is Bitcoin, and the tannish line is gold. And you'll notice that gold is a lot more persistently strong than Bitcoin. In fact, since 2022, we see that gold has pretty much outpaced the movement in Bitcoin. Bitcoin went from 20,000 up to about 70,000, so that's up about 3.5 times. But gold went from around 1,500 or 1,800 to 5,100. So gold doing pretty well. This is the chart that is getting a lot of attention. It's just the growth in private credit and BDCs. It's interesting that as the BDCs have really expanded, on the prior chart, we saw that Bitcoin is giving up the momentum, and maybe investors are speculating more in other assets these days than crypto. I heard somebody say something kind of funny. They said, Bitcoin is only for boomers. And it's like a real insult to boomers, I think, and I'm one of them. Here's the Bloomberg Commodity Index that I just referenced. You can see that it's really broken out above its 200-day moving average. It was crawling along that 200-day moving average for a couple of years, and then sparked by strength in energy and strength in the precious metals, we see that this is a very strong move. We're very far above the 200-day moving average right now on the commodity index. So it's not the greatest trade location to be buying commodities. You've really recommended them back in the middle of last year. And of course, if that's your purchase price down there at the 200-day moving average, you're sitting on a lot of capital gains. I would probably wait to implement a commodity trade a little bit for some of the froth to go out of this index. But this would be one way to play the commodity market. All right, here's the dollar index, and we say this goes back to 1975. And the dollar, if you actually look at this, it's been in a broad downward trend. This is the Dixie index, which is has a lot of euro in it. But you can say that we see a pattern of declining peaks. The peak was way back in 1985 before the Plaza Accord, and then we see the year 2000 prior to the dot-com bust. And then we've had more strength recently since the aftermath of the global financial crisis. But we see that there's this horizontal line on here. And I believe deeply that we're going to see that horizontal line in the price of the dollar sometime this year. If you would connect the rising, if you look at the rise from 2010 and connect the two low peaks in 2011, the two valleys rather, in 2011 and 2021, we're right at the edge of breaking below. We actually have slightly broken below. If you would draw that rising diagonal line. We've slightly broken below that, and the dollar is weaker again today. Here we see EM local debt compared to U.S. corporate total returns, and that's the tan line. And then we see the dollar index inverted. So what you'll notice is that EM local debt seems to outperform when the dollar is weak. When the blue line is going higher, the tan line tends to go higher, which means EM debt is outperforming. I recommend that investors have 30% of their assets in fixed income. When it comes to equities, I don't like momentum-based or cap weight-based equities at this point in time. I think that you have far too much concentration, and you can see that cap weight has outperformed equal weighted S&P pretty sharply since 2022, and really going back, with the exception of the COVID lockdown period, going all the way back for 10 years. But you'll notice that equal weighted has now begun to outperform, and in a way that's fairly convincing. So I think that equities should represent 40% of investor portfolios. So here's growth versus value, and we'll notice that it's not as convincing as the market cap weight to equal weight, but this also seems to be reversing from a high level. The levels seen back prior to the dot-com bust and prior to the COVID period. And now we're back at that, but it seems that pretty clearly that now value has been outperforming growth. And that's just kind of the way I'm wired. I don't like momentum investing. So I tend to favor value over growth, and I tend to value non-momentum things by using equal weighted. But that's what I'm recommending for equities. Here's U.S. equity prices versus the rest of the world. So we're just using the MSCI data here. And so we see that there was a trend line that was kind of containing the corrections from the rest of the world versus the S&P outperforming. But now we actually see that we're broken down below what was the trend line. And again, this looks like a fairly convincing reversal from a very high level. So I like having the European equities as part of the portfolio strategy. I would actually not be against owning emerging market equities, and I even own them in local currencies because I think the dollar is going to continue to depreciate. Here's again U.S. stocks versus the rest of the world, but now we've taken it all the way back to 1970. And you can see that there was a significant U.S. underperformance from 1970, which was the Nifty 50 period where that peak was hit of the U.S. versus the rest of the world. And then they got much cheaper into the late 1980s. And then they just went wildly outperforming since that period of time. This looks like a fairly convincing reversal to me as well. So still now for 2 years now, looking at the theme of non-U.S. equities being part of portfolio even for dollar-based U.S. domiciled investors. This is one of the reasons I believe that the U.S. outperformed. I think it's almost definitional. The U.S. net investment position went from foreigners having about $3 trillion more invested in the U.S. than the U.S. is investing in foreigners back about 20 years ago or so, or maybe even a little less than that, to now a 28% net position. So $25 trillion has poured into U.S. markets from foreign buying. And I believe that that's going to change as the dollar goes into a weaker situation. That would actually be one of the reasons why the dollar would weaken, because they would be liquidating dollar-based assets. I think that based on the valuations and based upon the geopolitics of the moment, that this reversal is likely to be a theme in the years ahead. Here's the valuation on a price-to-book ratio of the U.S. This is the MSCI U.S. index. It's not the S&P 500. It's the MSCI index. Price-to-book ratio was 5.32 at one of the highest levels of all time, rivaling the pre-dot-com bust. And then we see everything other than the U.S., which is the tan line, is at a price-to-book ratio of 2.27. Now, you might think that the U.S. has some God-given right to have a higher price-to-book ratio than the rest of the world, excluding the U.S., but you'll notice that there are periods of time when these price-to-book ratios are very, very similar. That dark blue line in the middle, that's just the whole world. So it's really just, it necessarily lives between U.S. and the rest of the world, excluding the U.S. definitionally. But there's a very wide divergence here in the lighter blue line and the goldish tan line. And I just don't think it's wise to ignore that huge divergence. This is the S&P 500 versus the MSCI EM sector of the global market versus the dollar. And it's pretty obvious that there's a correlation here. It's almost perfect. So when the dollar index is going up, we see the S&P 500 outperform emerging markets. And when the dollar is going down, typically the emerging markets start to outperform. It might be wise to look at emerging market equities. And of course, you get a double whammy if the index outperforms and the dollar falls versus other currencies, which appears to be perhaps in the early stages of happening. This is the S&P 500 versus the MSCI EM normalized. What that means is going back to a start date. And you can see just how much the cumulative outperformance of the S&P 500 is. Yet down at the bottom panel, more recently during 2025, emerging market equities outperformed and the currencies of the emerging markets outperformed. I think we're in the early innings of this as a theme, probably throughout the next several years. This is the same chart, just going back further, same as the prior chart. And once again, we see that this is a very long-term situation of high correlation. And we see the Fed trade-weighted dollar going back here has been vacillating, but I believe it's going to go lower. And therefore, the S&P 500, which has started underperforming, will likely continue to underperform. So with that, I'm going to wrap it up. We're going to be back a week from, Wednesday for Fed Day on March 18th. I look forward to giving you my comments on the presser from Jay Powell, and then I'll be back on CNBC probably the Monday after to take some questions from the Judge Scott Wapner. So with that, here we are already 20% through 2026 nearly. We're off to kind of a mediocre market start. Stocks are about flat, pretty much around in most sectors right now. S&P 500 down a little bit. NASDAQ down a little bit more. And bond yields are very little changed on track. So with that, thanks for your attention. I hope you appreciate the webcast. We'll start fine-tuning it now that we've got our inaugural issue out of the way. And with that, thank you very much for your support of DoubleLine, and goodbye for now.